Thank you for joining the class this evening. Well, while we are waiting for the other people to join, we wouldn't wait much. We'll start our class. So, let's start the class. Welcome, students. Okay, there's only one student here now. Okay, we'll start our class by bringing our class notes here so that we can begin in earnest. Okay, so today is session 2 of our taxation class. And in this session 2, we'll try as much as possible to finish the basics of taxation so that by next week, we will go into some meaty details about what your taxation classes or topics are all about. So today we will just be doing the other topic that is very, very important and which is linked to the one we did last time. Look at our class rules. We'll be doing 2 topics here: capital allowances and loss relief. Okay? So look at our class rules. I'm happy you're abiding to the rule number 1, which is to mute your audio and your video. I think that's the main thing I want to stress here. So please keep muting your audio and your video. Don't release it. Happy for that. You can ask questions at any time that you don't understand anything. Put it in the chat room. I'm looking at the chat room now. I will get to see your questions. Okay, so let's go straight now to taxation of business income part 2, which is capital allowance. So what we do today here is the same thing for sole proprietorship, partnership, and company, just as we did last week. Okay, so look at the capital allowances rates. The rates here are given here. So we're going to be referring to this page when we are doing capital allowances. Then investment allowance. We see the rate for investment allowance here 10%, and we said it's only on plant and machinery or plant and equipment. So this is plant and machinery. So we'll charge 10% first before we do initial and annual allowance. We do not charge on office equipment. So anything that is associated with plant, that is what we charge our capital allowance on investment allowance rather. Then look at our annual allowance, the formula. So we have to first of all know initial allowance first before we can find annual allowance. So because it's going to be cost minus initial allowance divided by the predetermined number of years. How do we get the predetermined number of years? We simply say 100% divided by annual allowance rates. Let's take, for example, plant and machine of years. We'll say 100% divided by 25%. So 100 divided by 25 will give you 4. So that would mean that N here is going to give me 4. Now, why do we say M over 12 here? M over 12 means if you are going to be prorating it, if you are going to be prorating the annual allowance, you are going to use the number of months that the asset was used divided by 12. This happens in the first year which is year one, when a business is beginning, you always prorate. It always happens the first time that the asset is being put into use, the very first year of that asset, this prorating will come. Then in the year of disposal, if it is not disposed before the completion of the predetermined number of years, that means if it is not disposed at the end of the year or the basis period, you will always get this prorated decimal because your M will be less than 12. But if it is disposed at the end of the year, then it's going to be M will be equal to 12. So this prorating will no longer be. If the asset was bought at the beginning of the basis period, also, that is in year one. If year one is the very beginning of the basis period and it's 12 full months, then this M will no longer be. But from year two to the last year of claim, if there is no disposal, M is always 12. So we don't normally see this prorating because from year two, we don't prorate. It's assumed that M is 12. After you've claimed all your capital allowances, M becomes 0. And if M becomes 0, that means your annual allowance will be 0. That means there is no claiming of annual allowance. Then you read up this rural investment allowance because it's rarely being used. But just know that these are rural investment allowances. Now we go to the basis period for capital allowance. The basis period for capital allowance normally follows basis period for profits, assessable profits. So it means that if we are doing a commencement rule and we say a business started July 1, the first year is be the same thing. It will be the same thing, okay? But there are some problems that we may come in contact with, which we call overlapping basis period and gaps in the basis period. When we were doing assessable profit, we said there are certain things that make this commencement rule, change of accounting date, and cessation rule abnormal. Is because of overlapping and gap. We are going to see how we are going to treat these gaps and overlap when we solve a question. Okay, then we have restriction on capital allowances. Now, if a company is into agro-allied or manufacturing company or industry, they are not affected by these restrictions. So when you look at a question that you know you're going to do with capital allowance, ask yourself, is this business into agriculture? Is this business into manufacturing? If you have detected these 2 points, then you say restriction on capital allowance does not apply. For every other company, it applies. And what is the restriction? It is 66 to 3%, or just simply 2/3. You know, there's a difference between 66 2/3. You must, if you are using 66 2/3, you must put the word percent. If you are just writing 2/3, use 2/3 without writing the percent. These two things means the same thing. When you simplify 66 2/3% if you simplify it to the lowest term, you will get your answer as 2/3. So just simply write 2/3, not to get complicated. We don't need to prove that. Now, there's what they call carry back of capital allowances. Whenever a business has reached cessation point, we are in the penultimate year and we get to the ultimate year. And there are capital allowances that normally are not absorbed. You're supposed to take it to the next year, right? But we don't do that. Instead of taking it to the next year, because the business is ending here now, we take it back. So there's no way we can take it forward. So we take it backwards for 5 years. So we start counting it because we are in the ultimate year, the year the business ends. So we start counting backward. Five years, starting from the penultimate year. So the penultimate year is the first year. The year before it will go back until the 5th year. We'll try to be relieving it from the remainder of the profits. That will mean that any tax we paid before will be refunded to use to clear your capital allowance. In the 5th year, if all the capital allowance is not absorbed or not relieved, any remainder cannot be taken to the 6th year. Okay, please, I don't understand capital allowance carry back. That's what I'm explaining. Capital allowance carry back. I will explain again. Okay, let's say 2019. Okay, let's say 2020, June 30th is the day a particular business ended. That will mean that 2020 is the ultimate year. Agreed? That will mean that 2019 will be the penultimate year. Now let's assume that we have capital allowances that have been accumulated, which we carried up to 2020. And because maybe we have a loss in 2020, we cannot relieve the capital allowance due to the loss. Normally, your loss in 2020 is lost permanently. That is the rule for loss. We'll talk about loss. It's lost permanently. But capital allowance is not lost permanently. You have the option of capital allowance carried backward, because since the business has ended, you cannot carry forward. Normally, the rule is carry your capital allowance forward until you have profits to relieve it. But here in the last year, you cannot carry forward. So you carry backward. So now you are in the ultimate year. You cannot go forward. All you need to do is go backward to the penultimate year. When you go backward to the penultimate year, whatever profit that was remaining, which you are charging tax on, use those profits to clear your capital allowance. Now, let's say your capital allowance is 1 million, which you cannot relieve. But right now, you have taken it backward to penultimate year, and you have only 200,000 as your profit remaining. Is that 200,000 you would have paid tax? You refund that tax that you paid in 2019, the penultimate year. Instead, you use that 200,000 to clear as much as that capital allowance you are carrying backward. So you bring in 1 million, 200,000 is available. So you take the whole 200,000 for capital allowance. It will remain 800,000. You will take it back again to the previous year. Let's say you have 500,000 in the previous year. You clear your, and you have 800,000 coming back. You say 500,000 will be able to be relieved. The remaining 300,000 will be going to the next year. That is how you'll be doing it until it will get to the 5th year if possible, backwards. And if it gets to the 5th year, you cannot clear all of them, the remainder is deemed lost. We are going to explain further when we solve a question. And now we are going straight into the question. The question will help us understand the topic. This is revision class and not a full-fledged detailed lecture, but I'll try and be detailed in my answers so that you understand them. Okay, so I want you to pay rapt attention. I want you to disabuse of your mind from anything you must have known. Take it anew. Exercise 2.1. James Nigeria Limited, so this is a company, commenced business as a textile manufacturing company. Now you look at it, it's a manufacturing company. What do we say about capital allowance in manufacturing company? They are not restricted. So you don't use 2/3 on them. Now, we said again, another keyword, commenced business. That means there's going to be overlap. Now look at the date of commencement of the business. Now, it was incorporated on this date. For accessible profits and capital allowance, this 5th of March does not apply. The only time it applies is when you are filing your tax. The date of filing tax is either 6 months after the end of this year, the end of this accessible profits, the end of this accounting year, 6 months after it, or 18 months counting from this date. So that is the only time this thing is important. So if you start your business in 2001, if you incorporate your business, register it with CAC on 15th of March 2001, and you start your operation in 2005, June 1, you will not say because you start business 2005, you will not file tax. They will start counting your filing your tax from 18 months of this date. So you still telling them that, look, I have not started business, so you'll be giving nil return, no business. That is what it means. But now we are not interested in this because that's not what's our attention here. So this date, 1st of June, is our important date. They now give us 3 years assessment. They now told us that the company had the following capital expenditure. So you can see that this factory building was acquired before the business started. So, of course, the business has been incorporated when it got these things. So, but the business has not started. This machinery was gotten after incorporation, but business has not started. The rest of them were gotten after the business started. Now, required. Determine the basis period for assessment. What do we mean by assessment? It means for accessible profit. Now, and for capital allowances. So you're going to be doing 2 tables or 1 table, these 2 side by side for the first 5 years of assessment. So let's see the solution to that. Okay, hold on where I get my solution. Now look at the solution. Now, the solution is this here. Year of assessment, the first 5 years. How do we know the first 5 years? The first year of business will be this first year that the business commenced. So 2001, it means 2001 year of assessment, 22, 23, 24, and 25. That is what the question is saying. So 21 down to 25. You've done this. Now, it is best to start with basis period of profit, which you already know. So what do we do in the 2001 basis period of profit? It will start from the date the business commenced. Remember last week? And it will end on 31st December 2001, the same year. Now, we were told to ignore right of election. So we will not do anything like right of election because that's not normal. We are going to be using, when we are doing capital allowances, we don't normally use right of election to teach that. So you see, this is the first year. We'll go to the second year. The second year, you will still begin from the date the business started. And I said, you're going to count 12 full months. I remember I gave you a formula. How do you know the 12 full months? You ask yourself, if this is 1st of June, what was yesterday's date? Yesterday's date is 31st of May. And if this one is 2001, just add 1 year to be 2002. That is how you know when the year ends. That's fine. 2003, the third year, I said you need to start from the ending. And what will be the ending? The date that the business is making up its account. So it's going to be 31st March. So you've put your 31st. Okay. If you put 31st March, if you put 31st March, that means it will need to start from April 1 to 31st March. So from April 1, 2001 to 31st March 2002, April 1, the business is not in place. Because in April 1, the business is not in place, you cannot achieve 12 full months on the third year. And so this is another rule for commencement of business. When you cannot achieve 12 full months in the third year, all you need to do is to repeat the second year as the third year. Normally here is supposed to be 31st of March. Then when you say at 31st of March, since this is 2003, you will say preceding year basis, this is 2002. So if here is 31st of March, what is tomorrow's date? It's supposed to be April 1. But in April 1, 2001, the business is not in place. So that is why that will not work here. So that's why we need to just repeat the second year basis period for the third year. Now, this rule I'm going to give again in the fourth year. So that rule I was telling you in this third year, it is from the fourth year it starts applying. It will now mean that in the fourth year, this is 2004, basis period, preceding year basis is 2003, that's good. 31st of March, that is when the account ends. That will mean that tomorrow's date will be 1st April. Remove 1 year from here, so that is how we got here. So when you do that, all you need to do in the next year is to bring the same date, increase the year, bring the same date, increase the year. That is how you'll keep doing it until you get to the change of account or you get to the ultimate year. So if there is no change of account, that is how it will be going like this from 1st of April to 31st of March. Now that you've done the basis period for profit, let us see how we will do capital allowance. I said in capital allowance, it follows the same basis period as that of profit. So whenever there is a commencement rule, the first year of capital allowance is the same first year of basis period for accessible profit. So that means it starts from the date the business starts. In fact, don't even say start from the date the business starts. It starts from this date here. And it's supposed to end on this date. So that's it. Now, what we are using this date for capital allowance is for initial allowance. This is mainly used for initial allowance. Now, what happens? The second year, we are supposed to start from the date the business commenced. But you see, in capital allowance, there is no room for overlap, and there is no room for gap. So there must be no gap and there must be no overlap. So that would mean that the capital allowance will not start again from here because it will mean overlap. So where will it start? We don't know. Okay? All right. Let's see here. This date that it ends, it's also supposed to end on this same date. So you see, it ends on this same date. This date is here. It's ending this date. So you ask yourself, enough. So let me get back to the slide that we have been using. Let's get back to the slide. Hold on a moment. Just a moment. Okay. Thank you so much. Let me share my slide again. I was trying to put certain things in place. Okay. Let me see in such a way that when you send your comments, I'm going to see them. Trying to see if I can see your comments whenever they drop. Okay, so thank you for your patience. We will So sorry again. Network is just dealing with me. Sometimes people will call my line and it will take off my network. I'm so sorry. That's the price you pay when you use your phone as a modem. Sorry. Okay, so we were saying that whenever there is an overlap or a gap, capital allowance does not allow for that. So let's go to the third year. In the third year, can we check if there's an overlap? There is an overlap. In fact, the whole of the second year was repeated as the third year. So there is a complete overlap. That means that our capital allowance date cannot start on this date. Now look at this ending. It cannot end on this because you can still find it here. We can find this date here. We can also find this beginning date here. So this is a complete overlap. So that's why we are saying dash. So you cannot charge any assets here on initial allowance. So you see that any assets that you bought in here will only be charged initial allowance here and not here, because this capital allowance is for in take notes. Go to the 4th year. This 1st of April 2002, it's here because it's before May. So I'll keep apologizing. Sorry, I'll keep apologizing for the. Sorry for that. Yes, I will explain it again. I was saying that hold on a moment. I need to know if all my students are in there. Okay. For the, so what we normally look at is this. Look at the big. Here is that. In May, since 1st of April 2002 is now let's look at this ending date, 31st March 2003. Can you find it inside here? That's why we are ending it here at 31st 2003. Somebody is still saying can't hear me. Please use earphone. If you are using your system, you can put earphone so that you can hear me. Kind of shouting here too. People are passing around, is looking at me. Why am I shouting? Okay. Now, we said because, okay, that means somebody has heard me, that it is not a matter of earphone. My line is breaking. Okay. So sorry. It's the network. So there's nothing I can do about network. I just have to keep trying my best. Network mind of his own. Sorry about that. Okay, so this April can be found here. All right. So if you put it next, add it to it here, then it to the next year. So obviously it's going to be the same. It's also going to be the same thing here. So no problem. And look, we have done the basic profit. Let's look at the we have purchased. Look at March 2000 factory. There's no, but because the business started first, all the acts that are for the business in the eyes of the law, they are said to have been purchased on June. So that means that this factory building and this machinery are seen to be bought on the 1st of June. And factory building and machinery is here. Furniture is bought on October 2001. So you see here, October is this size, so furniture is here. Okay. Now, delivery van, February 2002. So you ask, where is February 2002 should be here? Delivery van. What about motor van? May 22 motor van. Okay. Then office equipment is in January 2003. Where is January 2003? You can only get here. January 2003. So here you cannot charge initial allowance, only annual allowance. Okay. Now let's go to the second part of the question. The second part of the question is due for 5 years capital incurred by the company. So we only brought year of because choose this basis get to get this year of assessment basis for quarter we just here this in this place that was not there. Factory didn't it, but now let's deal with initial once again, apologies. Network is throwing me off once again. My apologies. Network is no respecter of person. I'm sorry about this. So let's continue. We were given this rate. These were the capital allowance rates we were given. And so factory and buildings. Where is the buildings here? Office building is here. Industrial buildings. Anything you see, buildings, non-industrial buildings, all of them have the same rate. So you see, let's say industrial building is factory buildings. Initial allowance is 15%. So we are going to use 15% of how much it was acquired. So what we are doing, we are saying 25,000. It's our 525,000. Then we go to machinery. Let's continue. Okay, so we saw that our furniture is 750,000. So if furniture is 750,000, that would mean that the rate for furniture and fittings is 25% initial allowance. So all we need to do is 25% of 750 got us this figure here, which is what we got here. And so when we add this figure to this figure to this figure, these three figures is giving us this bold figure. So that is for the year 2001. We use the same method for 2002. Delivery van is 50%. Once again, I apologize. This is becoming embarrassing. I apologize. Okay. Now, in the fourth year, there is, or that is in the third year, there is nothing here, so it's 0. In the fourth year, we only have equipment, and equipment, from what we've checked in our table, is 50% of the cost, which is 300,000. That's why we see it here alone. There's only one thing here. So that for initial allowance. So you've seen how I got my initial allowance. In this system, there's no allowance here. So let's go for annual allowance. Okay, let me use this place to give example here. Now, look at the formula for annual allowance. It's your cost allowance divided by days, which by annual allowance. If there's going to be per year of use, you are going to see there, going to use number of years of months used divided by 12 full months in a basis principle. So let's see how the annual allowance. So for annual allowance, this is what, okay? All right. Now allowance. You find out that for the first year, factory building, this is the cost factory building. This rate, this is the allowance calculated before, right? Now, that is the numerator. The denominator, how many years? We say 100 my annual allowance rate. So 100 divided by 10 is 18. This figure minus this figure, okay, let me see if my calculator will come up. If we do it by saying three million 500,000 minus 5 million 975. Now, when you divide it by 10 years and allow it, so every day you'll be charging 97,500. But for the first year alone, you know, the first year alone, there is no full year. So we are going to put it. So how many years, how many months did we use it? Okay. We started using it from March, but it is deemed that for business from that period, from June to December is 7 months. 7 months out of 12. That is how you are prorating this figure. That is 7,500. That is a 97 here times 7 over 12. When you prorate, it gives you figure. So this is the figure you are going to be using for the first. And look at it. That is the figure we use here. Let's go to the next one, which is machinery. Machinery was bought allowance, which so when we deduct it, we'll say 2,800,000 minus 1,400,000. It will give us 1,400,000. All right. We then said 100 divided by 25. 25% is the annual allowance rate. So 125 is going to give me 4 years. So it means 1.4 million divided by 4 years will give me 350,000. That is why 350,000 is the normal annual allowance we are going to be charging on machinery. For the first year alone, it is of will give you 204,167. So that's how we got this 204,167, which we used here. Then going to furniture and fitting, we do the same thing. Costs. This is the initial allowance deducted, and when we look at 100 divided by 20%, which is the annual allowance rate, we find 5 years. And so since it is 5 years, if I were you, I would be writing the years by years. All right. So when you are getting one first year of use, you started using it when? From the month of what? From the October. So October, November, December. 18 months out of 12, you get 28, 125. That is how I got this figure here. So when you add the figures, you are getting this. So what is your total capital allowance here? The total capital allowance is the sum of this and this. Will give you this figure here. So that is how we got our total, which is, what do we do? The delivery van in 2002, that's the first year we started using it. This is the initial allowance, and this is the cost. This is the initial allowance we calculated, which is this figure here, which we calculated here. Now, 100 divided by 25, which is 4 years. When we divide this thing by 4, say 4 months for use all over 12 multiplied by this figure. So that is how we got this answer here, which is the same thing we put here. Then when we get to motor vehicle, we bought it in May of that same year. And so see what we did for motor vehicle, the initial the cost minus the initial allowance is still 4 years divided by 4 years. You are getting 50 here. For the first year, and we bought this thing in May. So we are using it for just 1 month out of 12 months in the basis period. And so when we divide this thing by 1/12, we get 12,500. So that's how we got our 12,500. Then, how did we get this 760? There's nothing here. This 760 is the basis period of, is the annual allowance of factory and building for 2001, that for 2002 now, because you started charging from 2001. So this is their second year now, plus machinery, plus furniture. Their basis, their annual allowance amounts to, so let's calculate it. All right, let's see it is calculated. If you remember that rebuilding charged it before to be, this was the annual allowance, 297,500. So we're bringing full for the second year. For machinery, remember 350 here before we prorated. That was what we brought here. And for furniture, remember this 112,500 before we prorated. That was what we brought here. Sorry, here is this 3 I'm looking at. So when you add it together, you're having 760. So that's the 760 I was talking about here. So that's the 760 I got here. So you see, this is 760. So when you add 760 plus this figure plus this figure, you are getting this access to your annual allowance. You are having a total capital allowance of this figure. That's fine. Okay, so let's go to 2003. You see, there is nothing for initial allowance because there was no asset bought. But for annual allowance, we should have. Now, that, without saying much, this figure and this assets and this assets will still be counting their annual allowance, and we know it is 760. What about van, motor van, and motor car? We will start doing their annual allowance too, full annual allowance. So let's see how we did it. So you see, this 760 is the same thing as this 760 we did. It's just a repetition. Okay, for the assets of 2002, which is van, the full allowance was 62,500. Motor vehicle, the full allowance was 150. So when you add these two together, you have 212,500. So when you add these two together, you have 972,500. So that's what we did to get this 972,500. So that is the total capital allowance. Okay, now when we get to equipment in 2004, okay, so let's see what we did in 2004. In 2004, this is the cost of the equipment. Initial allowance of the equipment divided by 4 years is going to be 75,000. But since this is the first year we are using the equipment, we are going to prorate it. How many years was it used? This is January, and the basis period ends in March. So we use it January, February, March, 3 months out of 12. So we use it 3 months out of 12. So we get 18,750. That is your annual allowance, 18,750. So you remember this 972,500, which is all of these assets, this, and this, they are all having their annual allowance full, they will still come up again. That is this 972,500. You are bringing all of them in. So if you see how I worked it here again, okay, I didn't work it because I showed it there that you still bring all of them, because all of them was still used, you are still bringing all them. And so when you add this together, you have your allowance, add initial allowance, this fee. Initial allowance, nothing going to calculate that follow. So look at where did it. Now this isn't one capital allowances figure, according to how the question is asking us here. Compute the capital allowance due for the 5 years in respect of the qualifying expenditure. And the third one is accessible profit. I will still keep my table of allowance open. Fine. So let's get to the third part of the question. Now, accessible profits. Okay, if we remember our accessible profit table, our accessible profit for the year is this figure we are using, this period we are using, June 1 to 31st December of that year. So that's the same thing we are using. That's the same basis period. So all these basis period you are seeing here now, these are the basis period we used for calculating of profit. That's what we mean by accessible assessment. So accessible profit from June 1 to December is a 10-month period. And it's a 10-month period. Okay? But what they gave us, sorry, is a 7-month period. From June to December is 7-month period. But here, they gave us a 10-month period accessible profit of 7.5. It means we are going to take just 7 months out of the 10 months. So that's what we just did here. We took 7 months out of the 10 months given, multiplied by 7.5. That's what gave us this figure that we had here. Now, it is time now to relieve our capital allowance. What is the capital allowance for 2001? You go to where we solved it before and bring capital allowance for 2001. Sorry, let me get it back. Capital allowance for 2001. Okay, that's what we did here. This figure is what we are going to use. So that's the same figure. So we said it's a manufacturing company, and so it's not going to be restricted. There's nothing like 2/3 restriction here. So we take everything. So when we relieve capital allowance from this profit, we are getting our taxable profits to be this figure we have here. So our income tax is going to be 30% of this taxable profit. 30%. We are giving company income tax as 30%. So we'll look for it as this. Then your education tax is going to be 2% of your accessible profit. 2% of your accessible profit. Always remember that. So that's what you will do, and you get here. It's optional for you to add the 2. It's not compulsory, you must add the 2. But if you add the 2, this is the total tax. But it's not. Now we go next year. The next year, our accessible profit is still starting from the same date, but this is a 12-month figure. But in our question, they gave us a 10-month figure, which is 7.5. We will get the remaining 2 months by doing 2/12 times this figure here. So that is what we are doing now. That is what we are doing now. Sorry, just a moment. That's what we are doing now. 2/12 times that other figure. That is where we're getting the second 2 months. But the 10 months is given to us. So when we add 2/12, when we do anything we get, we add it to 7,500. To give us 9,500,000. Now bring your capital allowance. The capital allowance for that year is this figure, what we used here. We leave it, and this will be your taxable profit. So you now you get your income tax here. Your education tax is 2% of this figure. Now we go to 2003. Accessible profit, you see it. We remember that 2 was a repetition. It's not surprising we are doing the same working here. We are getting this figure, but our capital allowance will not be the same, because our capital allowance, we got a figure 972,500. So that's what we used here. So we got a new taxable profit. 30% of it will give us this figure. Your education tax does not change from the last one. Still the same figure. Now go to 2004. Going down, we are giving this profit that was starting. So the profit dependence. So 30% of it is our tax, then 8% of it is your education. We were giving this figure 18 million. So no workings, bring it 18 million. Your capital allowance remains this figure. You bring it down here, you get your taxable, your chargeable profit or your taxable profit. Look for 30% of it, that's your income tax. Look for 2% of this figure, that's your education tax. That way, we have answered the whole of question number 1. In question number 2, you'll be seeing something that has to do with cessation rule, and how we carry capital allowance backward. Now, Energy Resources Limited is a company engaged in the incorporation and sale of new electric cookers. Now, the company ceased business on July 31, 31, 2008 due to stiff competition from importers of fairly used cookers. So this date is remarkable. 2008 is the date the business ended. All right. If you look at the accessible profit, we can still see 2008 here. That will mean that 2007 is our penultimate year. So I said before that you cannot know your penultimate year until you identify your ultimate year. Ultimate year, July 2008. Penultimate year is 2007. Remember what we said we'll do for penultimate year in profit. We are going to be doing AYB with PYB and choose the higher. Okay, now they gave us profit figures. Now the difference between this year ended and assessment year is that this year ended is for profits. Now, you're going to be, this is the basis period. So if they say year ended 30th September 2000, that means that is when the basis period ends. The year of assessment is 2001. So when you see me doing 2001 year of assessment and coming to take year ending 2000 figure, just know that it is because they wrote year ended and not year of assessment. They are different. Year ended is for basis period. Year of assessment is year of assessment. So if I were you, after I see year ended, I will come here and write year of assessment. So I will put here 2001, 2002, or I can do it side by side. So this is 2001 year of assessment. I must use preceding year basis. This is 2002. And capital allowance is always given to you according to year of assessment. So you can see that they give us from 21 and not from 2000. So 21, 22, 23 up to 27. Now they now said that balancing allowance, which is a form of capital allowance, after disposal of all the company's fixed assets, they now disposed of them. They now found out that they didn't sell them according to how much is the tax written down value. And so they've sold everything and they made a loss. So this is the balance allowance on cessation amounting to this amount. And we are now told to compute the company's income tax liability from what year? From 2001, not 2000, from 2001 to 2008 assessment, giving all relief as much as possible. So this, I will keep this page open so that I will be referring to it. Okay. So our solution will come up here. Okay. Sorry. So yes, okay. Let me go back. So this is the second solution. All right. Now, in the year 2001, what happened? We are not interested in doing it like this, the capital allowance, because we're told to calculate capital allowance. It has already and the capital allowance figures. So all we need to do is to follow what they give us. So 2000, the business is not consistent, it's an ongoing business. Ending September 30th, from October 1, 1999. Every date will be going from October 1, where this one stops, to September. So that's how every year will be going repeatedly, because this is preceding year basis. So I will not be coming back to the preceding year basis. So we'll not be talking too much about the basis period because the business is not starting. There is no there's no change of accounting date. So it's still preceding year basis. 2001, you take figure for year ending 2000, 2002, you will take figure from year ending September 2001, things like that. So with that in mind, our accessible profit is going to be this. So that's what we did here. Accessible profit is this one here. Okay. Now, what is our capital allowance? Our capital allowance is 1,950,000. But look at the business. They said they are into sale of new electric cookers. So they are not agricultural business, neither are they manufacturing. They are just sales. So restriction applies to them. So that is what I want to let you know. So now that we've taken our capital allowance as 1.95, we'll bring it here. This is your 1.95. This is what you are supposed to be claiming as capital allowance. But how much will you really claim? You have to restrict it to 2/3 of your accessible profit. So when you do 2/3, you see here, you have 1.2 million. So you are going to put 1.2 million here. You are also going to repeat it here. There is a reason why you are putting them in two places. The first reason is this. This 1.2 million is what you are claiming as against 1.95 million. So when you deduct it from 1.95 million, you have 750,000 as the one that you did not claim, which will be carried forward to the next month. So if you look at it well, it is this 7,750 that came from this. That is why we put here. Okay, why do we put it here? It means that this 1.2 million that you claim, you are claiming it against profit. So when you use it to deduct from your profit, this is the remainder of your profit that you will charge to tax. Now, note that you are not doing it 2 times, you are just doing it once. But this is having a doubling effect. It has an effect on capital allowance by reducing your capital allowance. So this is the balance to carry next year. It has also an effect in profit by reducing your profit so that you will be charging tax on 600,000. So your income tax is 30% on 600,000, which is 180. You understand that? Your education tax is 2% on 1.8. You understand that? So we don't need to add them together. I said it's not compulsory to add the 2 tax together. It's optional. Now that we've done the first year, we'll go to the second year. The second year, you know, it will still, they gave you the figure. This is year 2002. We are going to be taking figure for year ending 2001. Year ending 2001. So that's where we are taking our figures. 2.3 million. So 2.3 million is our accessible profits. Okay? So capital allowance brought forward. So this one that was carried forward from last year, you are now bringing it to this year. Then, but how much a loan was charged for this year? If we go to our question, this is what was charged for this year, 2002, 920. So when you bring your 920 for this year plus the unrelieved for last year, you add them together, you are getting this figure. Okay? Now, how many are you going to relieve? You will still use your restriction, 2/3 of 2,300,000. So it's going to give you this figure. Like I said before, put it 2 places. This is the effect it is having on capital allowance, meaning that this is the balance that should go to next year. This is the effect it's having on profit, meaning that when you deduct it from profit, this is the profit that will be charged to tax. And look at the tax here is 30% of this figure. You get this, 2% of accessible profits, you get your education tax. Now that's for 2002. The same pattern for 2003. You go again, in 2003, you'll be taking figure from year ending 2002 because it's preceding year basis, 3,500,000. And that's what we did. Capital allowance, we are going to take 2003 tax year, 1,350,000. And that is what we did. But this one is as a result of this balance you've carried forward from last year, you are bringing it this year. So when you add it to this year's own, you have a total figure of this. Now, the relief to be claimed is how many? Surprisingly, I didn't do restriction. Why? You will always do restriction. When you do 2/3 of 3,500,000, you will get something higher than this figure. So whenever you get something higher than this figure, there's no need to restrict again. Just use the whole of the capital allowance, because your aim was that your maximum should be 2/3 of accessible profits. So when the 2/3 is bigger than this, you don't do restriction. So you take everything. So you see, it has a double effect. The first one, when you remove it, there is nothing to carry forward to next year. When you put it here in profit, this is the taxable profit remaining. That is where you are charging to tax and you get 604. You do your education tax, that's fine. You now go to the 2004 year of assessment. Okay, you are going to be taking your figures from 2003 ending September. So we are taking 15 as our profit. So you see this is 15. Capital allowance is going to be from 2004, which is 870. 870. So there was nothing from last year. So 870. How much to be relieved? When we do 2/3 of this figure, we are getting something higher. So we are using this. So whenever you see me don't do this 2/3, it means I would have done it before to be something higher than what we brought forward. And so no need doing it. So nothing to be carried forward next year. 630 was your taxable profit. This is your income tax. This is your education tax. For the next year, as usual, we took our 17 from 2004 year ending. Then our capital allowance happened to be 850. When we do 2/3, we found out that no need restricting. We took everything. When we take 850 from 17, we get 850. Income tax on this 850, we get this 255,000. Education tax 2% of 1.7 million, we have 34,000. Beautiful. Now let's go to 2006. We are approaching something interesting. As usual, we take our 12 from year ending 25. Capital allowance is 730. No restriction, like as usual, just as we know. Now, something of importance to me now is the 2007, which is the penultimate year. So we're going to be doing 2007. I call this one penultimate year, PYB. We are going to be taking 2006, which is this 950. That's fine. Now, penultimate year, AYB, is going to be from January 1, 2007 to December 31st, 2007. So I'll ask myself, where can I find January 1, 2007? I'm going to find it from here because this figure starts from October 1, 26 to September 27. So I'm going to find January here. So from January 1 to September is 9 months. So I'm going to take 9 months out. So that's why you see me 9 months out of that 12 months of 750. Then the remaining 3 months, I'm going to take it from this remaining 10 months because October, November, December are inside here of that same year. So 3 out of 10 months. So when I tidy them up and add them together, I have 660. But the tax authority would take the one that is higher. And so we choose 950, which is higher. So you see here, assessable profit choosing is PYB 950. And so if PYB is choosing as your assessable profit, that will mean that this 950 is also your capital allowance for the year of assessment 27. So that's what we see here. Year of assessment 2007 is 950. Surprisingly, your capital allowance and your profit are the same. So now, can you claim all of them? Of course you can't. All you need to do is to restrict. I didn't show the workings here, but you know here that there's a restriction here. 2/3 of 950 is going to give me this figure. That will mean that this figure has a doubling effect of affecting your capital allowance. So this one will be carried forward to the ultimate year. When you minus and you still get the same figure by virtue of the fact that these two are the same, these two are the same. So your taxable profit is still this figure. You find 30% of it, you have 95,000. Find education tax on this, you have this. That's fine. Now let's go to where it's interesting. And ultimate year. Now in the ultimate year, we're only going to do actual year basis from January 1 to what? July 31st. So that's 7 months. We are taking from January to July, 7 months out of 10 months. So that's what we did here. 7 out of 10, and we got 175,000. That's fine. Now, capital allowance brought forward. This capital allowance that was carried forward is still being brought forward. Now, we are yet to claim it. We now sold all the assets, and this was the balancing allowance we had. So we are going to add this balancing allowance to this capital allowance brought forward. And we have total allowance claimable to be this. So if our total allowance claimable is this, what do we need to do? Now, there is no need for us to prorate. There is no need for us to prorate because this is the ultimate year. The business is ending. Because if we prorate and say carry forward, the business is not going forward. The business is ending here. And so if your capital allowance is bigger than your profits, you take the whole of your profits as your capital allowance to be relieved. So it's having a double effect here. When you deduct this from this, this is the capital allowance that you should supposed to be carrying forward, but now you are going to be carrying it backward. When you deduct this from this, you are getting 0 profit. So you are not having any profit. And so there is no tax to be charged. So you didn't pay any tax here. You only paid education tax on this assessable profit. Now look at this capital allowance carried backward. We're in the ultimate year. We are going to take it backward to the penultimate year. So watch. Now, this is the penultimate year. Okay? So let me bring this one down so that you'll be seeing certain things here. Okay, now we go back to the penultimate year. Did you see this taxable profit brought down? This is the same thing as this taxable profit here. Mind you, it is from here we charge tax. In some textbooks, they will tell you to do 95,000 times 100 over 30. You will get this figure. Because we did 30 over 100 to get this figure. We did 30 over 100 of this, 30% of this. That was what gave us this. So if you are grossing this one up, sometimes they might just give you your tax. Your tax, if you gross it up by saying 100 over 30, it will give you your taxable profits. So these are the two ways. Either you put 95,000 times 100 over 30, or you take this one straight. So that's what we did here. The same thing here. Now look at the capital allowance that was brought backward. It is bigger than your profits. So you put the whole of the profits. It will have a double effect. That will mean that when you minus, this is what you would take further backward. So that's the second year you will take it backward. Now your taxable profit is 0. So that means income tax is 0. Previously, you had paid 95,000 as your tax, isn't it? 95,000 was paid as a tax. You are going to be refunded that figure because you have used it in your capital allowance. Now, you go to the next year before. So we go back now and we'll bring this our figure of 470. So that's what we did here, 470. So what we now do is this backward carried capital allowance is brought here. It is still bigger than this, so we can take every of the 470 from it, and you will have 1705 remaining. Your tax payable will be 0, taxable profit will be 0, 0 tax. That means the 141,000 that was paid before will be refunded. This 141 paid before will be refunded. Okay, now you go to the next year, the third year now, going backward. So I'm going backward now. So you see this taxable profit of 850,000, or you can even say 225 times 100 over 30 is the same thing, 850. That is what I have here. Now, this is the one we carried backward. We brought it down here. It's still bigger. We can claim the whole 850. We remove the 850 profit from it, so our profit is 0. Whatever tax that was paid before, 255 tax that was paid before, is going to be refunded. We go to the fourth year. Bring it up again. Fourth year. So you see this 630 here. That was the profit before we started charging tax. You bring it down here again. And you bring your 855 that was here. You less 630 from it. That's fine. That will mean that 225 will be what is remaining to carry backward. So no profit, no tax. So the tax of 189,000 which you paid before will be refunded. Now let's go up again to the last year, 203. So this 604,000 is what I am bringing down here. Sorry, it's supposed to be, okay, sorry. Look at it here. Taxable profit here is 2,013,333. So that's what we brought here. So this is what was carried backward. So you see, we carried it backward. And we have to relieve all our capital allowance. So you can see that we can relieve everything from this profit. So if you see now, we relieved everything on the last year. So nothing to carry backward again. If there was anything to be carried backward, it would have been lost. I wouldn't have written capital allowance to carry backward. I would have written capital allowance lapsed or lost. That would have been the figure here, but thank God it's 0. So 225,000 is what we can relieve here. That means your taxable profits should be this figure. So we're going to find 30% of this. So it's going to give you 536,500. So instead of paying a tax of 604,000, you are going to be paying a tax of 536,500. That means that they will refund you 65,700. 65,700 is the tax they will refund you. There's another way of knowing it. If you look for 30% of this figure, it will give you 65,700. That will mean that this 65,700, which was the tax you previously paid, will be refunded to be used to claim capital allowance. That is what it means. So now that we've done it, you see that the summary of your tax is for the year 2001, this is the tax you paid. For the year 2002, this is the tax you paid. For the year 2003, instead of paying 604,000, you are paying 538. Sorry, it's 538,300. It's a mistake. 538,300. Correct this. In year 2004 is 0, 2005 0, 2006 0, 2007, 2008. These are 0 tax. So if you look at it, it's 5 years. 1, 2, 3, 4, 5 years. You are paying 0 tax. You've carried it backward for 5 years. So study a similar example in November 2001 past question paper and see how this carried backward is being treated. This is the only time in the last syllabus that they treat carried back of capital allowance. So look at that question again and try to understand it. Our time is well spent. We would have entered into part 3, which is loss relief, but we'll take it to the next class, loss relief of business income. We're going to combine part 3 with the topic for next class. So do well to read it. It's just only one question here that summarizes everything. It's not because of time we would have taken it, but we'll take it in next class. So if there's any question you need to ask, please ask in the WhatsApp forum, because we have just 2 minutes to wrap up the class. Once again, I want to apologize for the network fluctuation on my end. Network keeps throwing me out, bringing me in, throwing me out, and people who are calling my line were also contributing to the network affecting me. So sorry, I apologize. The other students who were supposed to be here, we apologize for they not joining us to the end. They will have questions. Feel free to ask your questions throughout the week. I will answer them. I know there will be questions in this carry back, and I want to have questions from them. Thank you so much, and see you again in the next class when we'll be having tax matters. Good night.